Hello and welcome to our Stepping Stones podcast, supporting Americans with their unique journey through the UK. I'm your host for today, Holly Paling, Associate Director in the Expatriate Tax Team, and today I'm joined by
Chris Gabbett, Partner at LGT Wealth Management.
Rachel O'Donoghue, Partner in Buzzicot's Financial Planning Team.
Tom Buchan, Senior Manager, Buzzicott Expatriate Tax Services.
In this episode, we'll discuss pensions and investments. So to get us started, let's share our client Walter's story. Walter's an American and has been living in the UK for 6 years. He's been filing his UK tax returns on the remittance basis. He has a portfolio of US mutual funds as well as a variety of US and UK pensions. Walter would like to withdraw from his pensions in the most tax-efficient way in both the US and the UK, but would also like some financial planning and wealth management assistance. Step 1, let's review Walter's current situation. Tom, why don't you start us off by giving us an overview of the remittance basis and the importance of the 7-year window that's coming up for Walter?
Yeah, so Walter's a non-domiciled individual and has been using the remittance basis of taxation in the UK. This has meant that up until this point, he's not been paying tax on his non-UK investment income in particular. It applies to other things, but we'll focus on investment income. And at the end of his 7th year of UK tax residency, Walter needs to make a decision as to how he's going to continue to be taxed in the UK. If he wants to continue using the remittance basis, it will become more expensive. And our experience is that most clients decide not to go for the remittance basis after year 7 and switch to the arising basis, which is where they are taxed on their worldwide income and gains in the UK. Now, what that means is that Walter needs to think about his future UK tax profile, in particular aligning the US and the UK. And so what we will typically do for Walter is look at his investment profile and identify areas where we think action needs to be taken so that his investments hold a useful UK and US tax profile. What this will typically involve is looking at individual assets. Common ones are mutual funds or other collective investment products, which are non-reporting funds in the UK. What that means is that they are subject to income tax rather than capital gains tax. And if Walter doesn't take any action around these, what he can find is that in the future, when he sells those products, that there's a large UK tax bill which he may want to mitigate. It's tricky with UK-US people because you can't forget the US angle. And as Chris will give more detail around, you have to get quite specific about what products you go for. But on the understanding that Walter will take some action and look to sell out of products which aren't particularly useful and reinvest into products which have a better profile for him, we need to be quite specific to not fall into a UK trap of non-reporting funds and also the US trap of passive foreign investment company assets. They're often known as PFICs. What we will do is highlight what needs to be looked at and then kind of pass over to Chris and to Rachel to take a more holistic view of what needs to be done and work together as a team to find the best way forward for Walter. Sometimes we find that all Walter will want to do is to look at a short term, what are the investments I should go for? But in this example, which is not uncommon, Walter wants to take a more big picture view and think about future retirement and wealth planning in particular. And that's where Rachel would come in and think about what the next 15 to 20 years means rather than the immediate.
Yeah, thanks, Tom. That's really useful, and it's good that Walter's come to us before the 7-year point. So, Rachel, how would you approach a financial plan for someone coming up to the 7-year remittance basis change?
As you said, Holly, it is good that he's come at this point. So many clients, unfortunately, it tends to either be very close to the 7-year point, or it's at the stage where maybe somebody has highlighted, as you mentioned, Tom, maybe an issue with one of the funds that they have or what they hold at that point. We ideally, if we have the time, we like to take a bit of a step back and say, yes, there's a deadline here essentially if you want to structure your planning properly, but it's also looking at the bigger picture. So it's saying, well, there might be an issue with these funds, but it also depends, are you planning to stay in the UK long term? Are you likely to be drawing from these funds? What other assets do you have? Because I think what's really key, and we're very conscious of it when we work with clients, is that all aspects are important, the tax side, the funds and where they're invested, and the financial planning, but you really don't want to do those in isolation. If you're looking in terms of the wider plan, I would suggest ideally you say, what's the long-term objective? Will Walter move back to the US? Because that might make quite a difference in terms of, Chris, for example, where you might invest the monies. Also, with his pensions, he's mentioned obviously he's looking to retire in the next 5 years. How are they structured? What's the overall risk appetite? Really what you don't want to do is just say, let's sell out of these particular investments to solve a tax problem, but not look at the wider picture. Most clients will tend to focus on an individual aspect of that, but really we think it works best if you say, let's not just look over the next year or so, let's look at the next 20 or 30 years. If you do change the investments, that can result in some compromises in terms of the choice of investments you have, which I know Chris will touch on. So it's really key to think about, do we need to think of Walter as a long-term UK resident, US citizen, or perhaps he may actually be returning in the short term. So it's very much taking that first step back, really.
Well, thank you, Rachel. So Tom and Rachel, you've both commented on the importance of choosing the right investments or giving them a review. Chris, do you think you could give us a bit more information about that?
Yeah, absolutely. So as Tom said, the ideal situation is to find an investment solution that works in both jurisdictions, so both in the UK and the US. It's very common that we see clients come across from the US with a portfolio of mutual funds. They're very, very common in the US, and vice versa with passive foreign investment companies if an individual moves to the US, both of which don't really work in both situations. So what we need to do is often rebalance into a portfolio, as I said, that works in both the UK and the US. Now, unfortunately, that sort of restricts your investment a little bit, but there are plenty of investment solutions out there. So typical sort of solutions are investing into directly listed assets. So typical sort of equities, US equities, UK equities, European equities. Same goes for fixed income. And there are also a range of funds that can be held tax efficiently in a taxable account. As Tom alluded to, and Rachel, we wouldn't necessarily always say, right, okay, sell out of the US mutual funds just for the tax purposes. Obviously, it's an opportune time coming up to that 7 year, but long term, it may not be appropriate, particularly if Walter goes back to the US. Those investments work perfectly fine from a US perspective. So it's really, again, as Rachel alluded to, taking the long-term approach and saying, right, okay, if Walter's going to stay in the UK, take an income from his portfolios, then yeah, a rebalance is required.
I suppose as you said as well, Chris, sometimes even if a client like Walter has made the decision to sell, it might be staged as well. So I think that's often what we see is a gradual phasing of it. And again, the more time that we have in particular to plan around it, the better.
Yeah, exactly. And you can try and offset the gains with the losses as well. And then even if Walter didn't sell all of his mutual funds before the 7 years, then there's absolutely time and the possibility to do it later date. Typically what we would do in that instance is to open an account, or typical planning would be to open an account and make sure Walter's income and gains are kept separate for tax purposes, and then you can remit the gains onshore, the clean capital onshore.
Certainly sounds like you'd need to take the advice from all three of your advisors then to make sure you're not causing a problem in one of the baskets. So that now we've kind of had a look at where Walter is at the moment, maybe we could start our next step. So step 2. Planning for retirement. When Walter retires, he'll have passed the 7-year window. Rachel, how would that change kind of the financial planning work that you would do for that?
I guess it's the 7-year window is important because we'll have looked at that hopefully. But hopefully we'll also have looked at what we think his long-term objectives are and those of his family. So at that point, he's focused on retirement, but it's looking at it and saying, well, actually, let's do some cash flow planning around that. Let's see what you have now, what are the assets do you have, not just pensions for that matter. What do you actually need in retirement? Is that retirement going to be here in the UK mainly? Are you going to spend some time in the US? Do you have any assets there? So ideally what we'll do is we'll structure that cash flow plan so that a client, I suppose, has some certainty as well. So they know that if I'm going into retirement, do I need to make changes with some of my existing pensions, for example? Or do I need to look at other non-pension assets as well and see how that's going to generate income for me? I think often with retirement, people sometimes maybe get a little bit too focused on just the pension side or maybe a particular point in time. It's also looking at things like risk. So I think there's a little bit of a misconception around retirement and people reducing their risk as they get to retirement in terms of their investments. That doesn't necessarily have to be the case. Many clients of ours nowadays have what we call defined contribution pensions, so not fallen salary type pensions. And because of that, they're invested, but they're invested for the long term. And I'm sure Chris will touch on it later. You look at what do people need to draw. So again, part of that cash flow, but how much risk do you need to take? But being cognizant, obviously, of the US, UK complexities as well. But I think it's very much really just having enough time to plan ahead, because often with pensions in particular, there could be some restructuring that needs to be done regardless of the 7-year point.
Yeah, I think that's useful, particularly for somebody like Walter, who has a mix of US and UK, different kinds of plans, as well as his outside investments. So Chris, would the investment structure change, or kind of what's maybe in the pensions?
Yeah, perhaps. Again, from an investment standpoint, we'd like to follow the wealth planning. So Rachel would typically, as she mentioned, go through a cash flow forecast, cash flow plan, where, effectively a client will be able to see how sustainable their portfolio is in long term, because with Walter, he's going to start taking a draw pretty soon, and clearly you want to make sure that the investment, that the assets within the investments are going to last to death. So all of what we would do is follow on from the plan. And again, as Rachel alluded to, we'd structure a portfolio taking into consideration Walter's long-term objectives and the risk profile that he can take. Again, typical sort of kind of old-fashioned planning of that 50-50 equity or reducing equity exposure into retirement isn't necessarily always the best plan. We've been in an environment where interest rates have been particularly low for the last sort of decade or so, and that hasn't been a particularly strong area of investment for one, increasing the value of your capital, but also earning the income. So we'd have to look at how much income that Walter would need in retirement, and sort of structure the portfolio around that, and obviously the ability to take risk in the long term. In terms of the different investment pots that he would have, clearly he's got US retirement accounts, so a 401k. He's likely to have UK pensions, having worked here for 6 years, and he's got the brokerage account. So in order to provide the income, it's likely to come from various pots. Again, that would take into consideration the tax side of things that Tom spoke about, and also his sort of long-term residency. What we often see is where an individual has a large investment pot in the US, and they retire in the UK. You might not want all of the exposure to the dollar in the US, so you start to take a draw from your US assets first, and then leave your UK assets alone. There are tax benefits to that in terms of inheritance tax as well. But it would be we wouldn't necessarily change the structure of the accounts. We'd certainly look at changing the underlying investments to make sure they're tax efficient. But nothing would particularly change from the investment point of view. So historically, what individuals do or have done is to reduce their risk into retirement and then in retirement. But what we've seen over the last sort of decade or so was interest rates falling, where the sort of income from your portfolios has decreased. So that traditional sort of technique of reducing risk into retirement isn't always the best policy.
I think what you said as well, Chris, in terms of reducing risk, that was perhaps always as well before, when people would sometimes use their pension pot to buy annuities.
Yeah.
So I think maybe it goes back a little bit to that of you reduce the risk as you're getting near retirement to preserve your pot. Whereas when you and I work with clients, it's often about looking at that total return. It isn't about the income retirement, really.
Exactly, yeah. So when we're looking at a client's income requirements, we won't just look at this sort of yield from the portfolio, which is typically sort of coupon payments from fixed income, and sort of dividend payments from equities. It's the growth as well. So we'd look for a total return figure, of the portfolio, which would combine the growth and obviously the income too, and then that can provide the income for Walter in retirement.
So it certainly sounds like we need a good plan in place. I guess we're assuming at the moment that he's going to retire here. But Tom, I don't know if you wanted to go into a bit of detail of how that might change if Walter's plans or his family's plans changed and he went back to the US.
Absolutely. I mean, we always need to remember that we're dealing with human beings here and life takes over to a degree. So in all of this planning, there is a degree of can we crowbar in flexibility. And so certainly when Chris is putting together his package, he'll be thinking about, well, what happens if they're no longer a UK taxpayer? From a pure tax perspective, in terms of going back to the US, if they want to retire in the US, we do see that quite often, even if it's in their later retirement. What Walter might want to do is to do some big picture planning, so maybe gifting away some assets or thinking more about the inheritance tax. And it gets quite difficult to put a concrete plan in place there. But as part of this exercise, what we can do is look at what might want to happen and then see are there any conditions that would make it sensible to do now rather than later. In particular with gifting, if market conditions suggest that now is a sensible time to gift to friends or family, we can give some advice around that. It's really a question of, after the most important thing, which is the wealth planning and the investment planning for retirement has taken place, are there any areas where we can see some obvious wins, and then we can bolt that on as part of a package.
I mean, I guess it can be a bit of a crystal ball experience.
Yeah.
You don't know, who's what tax system's going to be like in 10, 20 years' time. So step 3, we've kind of put the plan together, but now Walter actually wants to start withdrawing from his pensions. So he was keen to make sure he minimises his US and UK tax exposure when he does this. Tom, how do you think, what would you suggest he does to do this?
So this is where it gets a little easier because you're dealing with something that's immediate. Commonly with UK-US taxpayers, what you'll be doing is looking to the governing tax treaty to understand how the taxing systems align with each other. And then within that, depending on what Walter holds, you can identify some areas to what you would do is look at what are the areas he should draw down from first to minimise his overall tax bill. And so typically when someone is retiring, having worked in the UK, they will have generated foreign tax credits in the US tax system. They have a limited lifetime, and so you will look to opportunities to use those. So that might be prioritising certain pension pots first, or there might be other reasons why you would look to go for a US pension first, but that's what we would do. We would look at each individual case by case and say, well, that's the right answer for you because that will help you minimise your overall tax burden.
Yeah, and I think there are some clever things that you can do with the US-UK tax treaty, so definitely good to take that advice before you make those withdrawals. So Rachel, were there any pensions that you would suggest Walter withdraws from first, or should he kind of keep some of them back a bit?
Short answer is it depends, really. Obviously, Walter's situation, it has certain things in common with other clients that we see, but it very much depends on where Walter needs to spend the money, what his long-term plans are. I think even outside of thinking of it as a source of retirement income, it's also, is there anything else he could be doing with pensions? So if we look at, say, UK pensions, for example, there's been a lot of changes in recent years, particularly the last decade, that make them quite flexible as well in terms of passing on, whether it be to family or to anybody else the person wishes to. So at the moment, if we were working with him and we were restructuring his pensions and making them as flexible as possible, we would also be having discussions with him to say, well, if actually we've done a cash flow and we know how much you need to draw from your different assets, do you have a preference in terms of whether you'd like to leave certain assets to your loved ones? And if you have sufficient assets overall, would you be open-minded to actually looking at some of the pensions as an asset to pass on? So increasingly, I have clients where, whether it be their children or grandchildren, they're often earmarking at least part of the pensions for that rather than traditional retirement income. So again, the US and the UK and the timings of it, the tax side is really important, but I would say it shouldn't be solely driven by that, in that if an individual thinks, well, actually, I am going to be in the UK long term, that's one thing that might be a reason for them to draw more from their pensions. If they're going to be in the US for a lot of that, often a UK pension can be really tax effective from an estate planning perspective. So again, and I'm probably repeating myself, it goes back to looking at that overall plan really and what they're trying to achieve. But we'd worked very closely, and we have done in the past, with some clients where we think actually they're moving to the States and we know they are and it's quite definite. We would really want to focus in on the UK pensions, because once they get to the States, as you guys will know, often you find that the UK pension providers don't want to deal with them when they're US resident, or if they do, they won't necessarily give them the same flexibility as they might if they were here. So they might need to take advice through an advisor, even if they felt that wasn't necessary, that the provider might insist on that. Again, it's much better to do that before one goes, or at least to have put the arrangements in place, because that can be very frustrating, as you'll know, for clients who've moved there without thinking actually that I need to take advice on my UK pension. So not answering your question, obviously, Holly, but I suppose ultimately it's very much, we're all aware of the planning opportunities, hopefully, and it's trying to look at those within a client's position as well.
And I guess, Tom, on the tax side, there's different rules with when you taking tax-free lump sums.
Yeah.
So we need to think about that, wouldn't we?
Absolutely. So the treaty provides some very useful tools. Pensions are actually probably the most generous article within the treaty. There's generally good corresponding relief between the two jurisdictions. And also there are some things that become kind of popular within the market that also the treaty can help out with, possibly in unintended ways. I'm possibly stepping on Rachel's toes here, but something we've seen over the past few years is defined benefit pensions being cashed out into a more traditional kind of cash pot, and in the UK that can be achieved tax-free. And it's not always the case that you want it to be tax-free for US tax purposes, depending on the client's circumstances. It might be better to take the tax hit now so that you don't have it later. So those are the kind of things that can be looked at depending on individual circumstances.
Thank you, Tom. So, Chris, I think we touched on kind of the investments in the pensions, and then we also mentioned investments that Americans or UK people shouldn't have. Does the pension wrappers give any protection in that situation?
Yeah, they do. They do. So the passive foreign investment companies that we mentioned earlier that are taxed quite aggressively in the US, typically in a taxable account, there's some flexibility on holding them within pensions. So that can provide some diversification from an investment point of view, where you cannot get certain exposure through more tax efficient investments. So what I mentioned earlier, being directly listed equities and fixed income and some ETFs, there is some sort of diversification benefits of holding those typically or sort of passive foreign investment companies. From a sort of, in Walter's case, Rachel alluded to it, it's quite a niche area where you've got a UK plan and a US resident is drawing from that plan. Walter's going to need to find an investment, a pension administrator that will work with US taxpayers, that work well with their tax advisor as well, and often it typically comes down to whether that investment administrator, being the pension administrator, will provide a sort of standing order in dollars or sterling, or be able to hold certain investments as well. So that's where Walter needs to sort of seek advice through his pensions.
Yeah.
I suppose it's also the amounts as well, isn't it? Because sometimes if somebody has a relatively small UK pension, you don't want to overcomplicate things. And often, again, if you're looking at the bigger picture, you might say, well, actually, if this is how much someone needs to draw per year, maybe that could be skewed more towards the UK pension initially, rather than just considering and thinking automatically as a long-term vehicle. Yeah. I think in Walter's case, it doesn't appear he's likely to have a lifetime allowance issue. But again, that's another issue that people here in the UK often do. They've got to think, actually, I might pay a UK tax charge just because of the size of my fund. But he's been here 6 years, so probably hasn't been able to acquire the level that would incur a tax charge.
Yeah, it sounds good to get things set up now, so if he does move back to the US, then he's got that flexibility and doesn't have to revisit things. Like having the right advisors that can give that continuation are really useful.
Yeah, I mean, equally, we see it quite a lot where, even though Walter now lives in the UK and looks like he's going to be in the UK for some time, him and his family may still have a house out in the US where they'll spend a summer or 2-3 months a year. So that's where we've got to be very flexible from all of our advice, really, not only the investment solution.
What we often see as well is not only that, and it's people spending 6 months or ideally with the right tax planning, not 6 months and 6 months, but something similar to it. But adult children as well and grandchildren are a big pull. When you're 60, 70, you might not be thinking about when you're 80, but we do see people move back to the US because their adult children live there and they want to be close to their grandchildren. So it's very important to think about these things.
So we've talked a lot about pensions today, but maybe we should move on to step 4, which would be alternatives to traditional retirement planning or generally pensions. So Rachel, do you have any kind of suggested alternatives that you see quite a lot with a US-UK client?
It's a good question, Holly, because a lot of people do focus on the pension side, but when clients come to us, it often is saying, well, if we've looked at what income you need, really, it shouldn't really matter what asset it comes from. So what we're always trying to look at is that the tax is important and that you want to keep the difference between the gross, so the pre-tax level of income, and what you actually receive in your bank account each month. Keep that difference as low as you can. But at the same time, it arguably doesn't make a difference what pot it comes from. So whether that be a general investment portfolio, would it be ISAs for some clients, not always maybe for US citizens, whether it be from Roth IRAs that people have from the States or their US pensions. Really, you're trying to look at it and see, well, actually, what's the most effective way of producing a certain level of regular income, or if you need capital from time to time. So that part, I think, is really, it goes back to having that plan in place rather than just focusing on pensions. And most of our clients, they don't tend to receive just one source of income. It does tend to come from many non-pension assets, and like we said earlier, there'll be reasons they'll actually park those pensions because they're thinking of them for a different purpose or maybe at a different stage in their lives. And you must see that all the time, Chris.
Yeah, we do, and sort of, as you say, historically, when people say, well, individuals save all of their life into pensions predominantly, so they think, right, okay, that's my retirement pot. Well, actually, it may not be the case. It may be ISAs that have been accumulated over the years, brokerage accounts, general investment accounts that have grown over the years. And again, although you don't want to sort of let the tax lead in these scenarios, it can be quite important to sort of say, right, okay, we'll take some income from pensions up to a certain tax bracket, and then the remaining pot from a brokerage account where it's not going to be taxed to income on the way out. So that's we see that all the time. Historically, given the sort of pension benefits or the tax benefits of having assets in pensions, where particularly in the US they can grow free of tax. In the UK we do have a lifetime allowance, but you kind of want to keep quite a lot of your assets in those accounts because you're saving tax on the growth. What we found fairly recently, and depending on market conditions, is there's an option to, it's fairly niche, but there's an option to move a 401k potentially into a Roth IRA or an IRA into a Roth IRA, effectively paying the tax now and then moving into a sort of more tax efficient investment in long term. I don't know if you come across that, Tom.
Yeah, we do see it. We see it with clients who like to take that kind of niche action. I mean, I would say that clients fall into two categories. They like big picture, big value kind of planning, or some clients like to make those more tactical decisions, doing it year on year. Yeah. So it depends on the client, but they definitely do like to think about those things.
I think it's particularly useful for UK resident clients who might have built up a lot of foreign tax credits.
Yeah.
That can be quite useful in those kind of transfer tax saving ideas.
I think often sometimes it's just a change in how you look at things as well. So clients often coming up to retirement have a way of seeing their assets and where they expect their sources of income to come from. So I usually spend probably the first year or two before someone retires and after it just reassuring them that actually if you're taking more from one asset but less from another, as long as the overall picture is on track, that's fine, as long as you know what the plan is. But it's quite difficult to go from earning maybe a regular income or if you're self-employed or otherwise, and then suddenly thinking, this is how much I need each month, a year. Where does it actually come from? Particularly if that isn't a fixed pension coming in. There's that, I suppose, psychological part to our roles as well, to actually reassure people that, we know what the plan is. It isn't just about the nitty-gritty.
Which is where your cash flow forecast comes in so handy, I find, where, clients can actually see on paper, right, okay, my investments are sustainable for X number of years, often, after death and through inheritance, etc. But they can see, right, okay, I can fully afford to take X per month or quarter or year.
I guess we touched on inheritance tax as well. I don't know if, Tom, you had anything more to say on the kind of US, UK inheritance tax?
Well, inheritance tax is always at the forefront of clients' mind. I mean, there's never a client who doesn't ask at some point in a year, is there anything I can do around it? Because regardless of how anyone feels about it, inheritance tax is a big issue for people who have worked all of their life and feel like they want to pass something on to their family. There are some opportunities. I mean, it gets interesting in that the US system is far more generous than the UK system. So again, it comes down to having the conversation with the client and tailoring your advice to them. Are they going to be in the UK at death? If they are, well, there are probably some more aggressive things, or maybe you would like to do kind of gifting earlier because the UK rules are a little different. So it's less likely that Walter's going to have an estate tax problem in the US unless they're in the super wealthy category. You really have to kind of help clients. As you said, it's more about the assurance side of things. So it's about taking that newspaper headline that they've seen, making it real and going, well, this is how it applies to you. Oh, there is a problem that we need to look at. Well, let's go and look at it. Actually, there isn't a problem. Don't worry about that.
Yeah, I guess we have another podcast in the Stepping Stone series, so there's lots more information on there.
We don't want to steal their glory.
Yeah.
But as you said earlier, Tom, with the pension side, because obviously the treaty is probably more specific and more generous than others, that again is one thing where it's a little bit more straightforward in terms of your UK pensions, going back to what we talked about earlier. So it's...
And sometimes doing nothing is a good answer. But
So it definitely sounds like Walter needs his advisors kind of to work in tandem on all of his planning objectives, especially coming up to the 7-year rule, but also, in the future as well. So could each of you maybe give me 2 top tips with what you'd give Walter at the moment?
Yeah, you're absolutely right. And I think where Walter's benefited is coming to his advisors early and them effectively all working off the same hymn sheet. What we do really is make sure that Walter's going to avoid the pitfalls and sort of make the most of some of the opportunities available to him. So something we see a lot with individuals moving to the UK or moving to the US is what we were talking about earlier, the non-reporting funds. So avoiding them, making the most out of the allowances with them from a tax and planning perspective. But really, it's another top tip is just looking at the bigger picture. So although he has US investments and UK investments, you want to take a holistic approach with everything from tax to planning to the investment advice. There's no point in having your US accounts being managed in a totally different manner to your UK accounts, and vice versa. You really need to be quite flexible and bring everything together.
Great, thank you, Chris.
Just 2. Chris has stolen one of mine, so...
Sorry, Rich.
So I think the points you made are completely valid, Chris, and that it's good that Walter has obviously allowed time. If it was a different situation, I would probably say making sure that you do allow enough time in advance. Particularly, I think if you're looking at the UK pension side of things, if Walter wants to keep his options open, whether he might go back to the States or not, you really want to look at the structuring of his existing pensions, how that fits into his wider planning as well, and allowing enough time. When people are thinking about whether it be the 7-year point or retirement, I think they often think that actually you can restructure assets quite quickly, and wrongly or rightly, a lot of pension investment providers getting details, reviewing it fully, it can often take a lot more time than people expect, really. And the last thing you want to do is find that you're near a particular deadline and really up against it. Another top tip that I would say, Holly, that might be useful for Walter or somebody in a similar position is looking at all of their assets in the context of overall risk and the level of risk that they're happy to take. Many clients that I speak to, they think they're comfortable with a certain level of risk. They think their assets are managed in that way. But actually, when we look under the bonnet, that's not often the case. Sometimes it's historic. They were set up a certain way, maybe not reviewed regularly. Sometimes as well, it's just that it's not very clear from the investments or pensions they have. So it's very much, I guess, coming back to what Chris touched on and what we said earlier, that bigger picture. What risk are you comfortable with, and how much risk do you actually need to take? And seeing what you've already got in place and whether changes need to be made.
Great, thank you, Rachel.
From a tax perspective, it gets a little more specific in the kind of the top tips from our angle are what you would look to do to make sure you don't have a problem on a given return. Because if the planning's done right, it should all come out in the wash there. But the things that people often don't think about are when to pay the tax. Because if you, in particular, if you have a UK-US person, when you pay the tax isn't always at the same time. So you need to be checking in to make sure you're not creating a problem by paying tax too late. I would also say that I want to reflect back on the PFIC and the non-reporting funds, because Holly, you and I would have had countless conversations with clients where you just see their heart drop when you give them the bad news. You know, they've done the right thing, they thought they were being sensible, and they've walked into a problem. So that's, you know, a key takeaway is make sure you if you have a portfolio of investments, they're not non-reporting funds or they're not PFICs if you're a US person. I've also got a third, which is, and I think it applies across the board, which is, if you're doing this kind of life event planning and you're not taking advice, quite often you'll be told you can't do that. And that might be true, but make sure you understand why. I had a call with a client this morning who had been told she couldn't have an ISA because she's an American. And that's just not the case. As Chris has explained, it's about what you hold in your ISA. The detail is important, but you can have an ISA. So often it's about that bank doesn't want to do that for you or doesn't want to work with you. And so that's where coming and having some broader advice just really helps you understand your options.
So it certainly sounds useful for Walter that his advisors are kind of joined up on the US and UK side. I think particularly on the tax side that the person preparing each tax return understands the rules in both countries and claims all of the reliefs to prevent double tax.
I would agree on that. I think often the client can be piggy in the middle if they don't have a team that can kind of handle it for them.
It'd be useful to learn how each of you actually kind of approach this with your clients, kind of when do clients come to you and how do you help them?
Yeah, so at LGT, well, much like all of our firms, we like a client to come to us well in advance of any sort of big life changes, but we work with UK, US individuals to assist them, as I mentioned, to avoid some of the pitfalls that we commonly see and to take advantage of a lot of the opportunities that are out there for them as well. Critically, you know, where we come in is a joint approach where not only we'll work with the client's other advisors, but a client's potentially they've got a US manager as well, being a US resident or a UK manager. We can work with their different investment managers, but you know, as I said, it sort of comes down to working closely with them and taking a big picture approach.
And I suppose on my side in the financial planning, Holly, ideally the way we work with clients, you know, as everybody said, obviously is to be able to plan well in advance, but also it is sometimes you do feel you're giving the bad news, like what you were alluding to, Tom, but actually there are lots of planning opportunities. So as long as somebody is, you know, doing the right things, they're taking a bit of time to plan, they're being clear what their objectives are, you know, we can work with clients very effectively. And usually all it really means being a US citizen here in the UK is that, yes, you need to be a little bit more careful in how you do your planning. All of the work that we do, obviously, is very closely linked with tax. We're very lucky in that we obviously are not tax advisors in the financial planning side, but we have a specialist tax team. And that really, I think, is where it works well, is if the two are joined up, ideally not done in isolation. And that's how we work with most clients. So we will do one-off planning pieces, but as we keep coming back to, I think the main thing with having effective planning in place is looking at it firstly and structuring it properly, but also reviewing it. Everything changes over the years. Legislation changes. Investments obviously need to be held in a review, and it's that's the way I think it works best.
Great, thanks, Rachel.
I think that's absolutely right, and it's how the expatriate team works with their clients, albeit in a slightly different manner. So we will typically do a client's UK and US tax returns, and that's a really good platform to understand that client's financial picture. And then depending on what that shows, we may make unprompted suggestions to come and speak to Chris or Rachel. Sometimes there are just some key obvious events, such as I'm retiring, what do I do about this? And so it takes care of itself. But having that ability to almost do a mini financial audit by doing the tax returns is a real vignette into what's going on, and being able to add value by making suggestions outside of the compliance cycle.
I think another benefit of using a sort of UK-US specialist investment provider, investment house, is the tax reporting that's provided to clients. We see it all the time where a client has a US investment manager that won't provide a UK tax report, for example, in sterling and on a fiscal year basis, and vice versa. If you've got a sort of a UK investment manager, they often won't provide a US specific tax report, and we all know that that can be quite costly and inefficient from a tax point of view.
Yeah, I mean, I would completely agree. I think it's one of those areas where it drives up the cost of a tax return unnecessarily, and it's one of those areas where if you have the right conversation up front and say, well, yes, the fees for this investment or advisor is this, but what you get from it as a benefit is not having to pay our fees. I mean, I'm doing ourselves out some fees here, but the reality is you get a happier client, and a happier client is a better client because things are working well for them. And so there's definite value in having the right type of reporting for UK and US tax.
I suppose it's also, I know sometimes when we do due diligence on investment managers, many people will say we can do the reporting, but what's really good when we're working with you guys is that we say, here are some examples of what the report is, and actually it is a complex thing to get right, and there are still managers out there where they're not, not just the US-sided managers either, and as you say, clients don't like the idea of paying for something where they think there's no real value in it. But yeah, it is a really important point, and it's the one we see probably people getting wrong the most, really.
Yeah, absolutely.
So thank you for our speakers for joining us, and thanks for our listeners for tuning in. Plan your next step by listening to another of our episodes in the series, which include marriage, business and property. Thank you.
Thank you.
Thanks.